Welcome to the Capital News. I am your host, Alex Karitis. Today is Wednesday, April 1st, 2020. Thank you so much for joining me. Since it's April Fool's, the title of today's podcast is A Bunch of April Fools. And boy, do we have them all over the place. In this country, around the world. Here in this country, they're in Congress, they're at the Federal Reserve, they're in the White House, and of course, they're spread throughout the entire country because, ladies and gentlemen, we're all fools. Because we're all being taken, we're all being played as fools. As we have a financial coup d'etat taking place right before our noses. At breakneck speed. The printing press is on overdrive. Congress is spending money like it's going out of style because it is. $2 trillion followed by another $2 trillion, and God only knows how much further this is all going to go. And what is being used as the justification for all of this insanity, for all of this foolishness? Well, the global pandemic. Because, of course, when you have a global pandemic, you have to just print money and spend money all over the place for a whole bunch of things with no accountability. I mean, can you even imagine how much fraud and corruption and outright theft is going to take place with all of this money? Whether it's in direct payments, whether it's through loans or guaranteed loans or subsidies, whatever they're going to do. Can you just imagine how much fraud is going to take place? And who's going to investigate this? Who's going to oversee it? Of course, the White House, the president, doesn't want to be overseen. No, we can do whatever we want with hundreds and hundreds of billions of dollars that we have our hands on directly. Whatever we want to do in conjunction with the Federal Reserve, that's what we're going to do, and you're not going to ask any questions. And if you do, we're just going to say, no, you're not going to know what happened, and we're not going to let you look, because that's how we do it here in the United States of America. This is what happens when you nationalize businesses. This is what happens when you allow a government to get this big. This is what happens when you place this much trust in government, which by itself, by definition, would make you a fool because you're just flat out ignorant, because there's nothing but history that tells you to be skeptical of government. In fact, the founding of this country was based off of such an ideal, such a principle. The Bill of Rights doesn't control the people, doesn't keep a check on the people, it keeps a check on the government. That's how this is supposed to work, but more and more, all of these laws are to keep checks on us. Stay in lockdown. Stay in your home. Don't go anywhere. Don't worry, we'll give you $1,200. Sit down and shut up. That's not enough for you. Well, if you were working, you might get lucky enough to collect an extra $600 per week as you collect unemployment. And I imagine, ladies and gentlemen, because of the behavioral changes that are likely to ensue once it's okay to go back outside, most people are going to say, well, you know what? I was working, and now I'm collecting unemployment, which was pretty decent. But now with the extra $600 kicker, it's better to just stay at home. I can take care of some things, especially for people who might be married and have children, or have somebody in their family or somewhere in their close circle that has a health condition, older parents. And you say, you know what? Yeah, I could go to work, but I'm being paid. I'm okay. I can sort of make ends meet with this. And I don't want to risk getting my kids sick, my wife or husband sick, or my parents who are elderly sick. So I'm just going to stay home and collect this money, which by itself will exacerbate the problem because you need production to grow yourself out of this. Handouts and bailouts are not stimulus. Production, working, is the actual engine. And of course, hopefully that is predicated off of a solid capital base, which would mean savings, but of course there's no savings. So it's sort of a catch-22 here, but that's actually how it's supposed to work. But if you incentivize people to stay at home, which will happen, it's going to happen. I'm not saying this is going to be everybody, because it's not going to be, but it's going to be a sizable portion. And you aggregate this across the country, and it adds up very, very quickly. So it's just going to make the problem worse. It's going to drag this out even further. Market performance today down pretty much across the board, across the world. Dow, S&P, NASDAQ all down a few percentage points. The small cap, the Russell 2000, down several percentage points today. And again, that to me is, your leading indicators, the small and mid cap indexes, which continue to get pummeled. And this is because, all else being equal, it's these companies, it's the smaller and mid-sized businesses, they're the ones that are not. They are not going to be bailed out, especially not to the same extent as some of the bigger companies. And a lot of the bigger companies are, of course, seen as quote-unquote safe or at least safer haven assets. It's okay to park your money in Google and Amazon and Microsoft and Amazon because, they're invincible. They can never go down. Where have we heard this before? And I came across an interesting comment on Twitter today. Peter Schiff, who I've mentioned here many times before. I'm sure many of you have also heard of him or have seen him on TV or some online interviews. Again, check him out, Peter Schiff. Definitely worth the listen. But I came across one of his tweets, and he made a fantastic point. In consideration of a lot of the people who are going to be filing unemployment, and we're going to get those numbers out here this week, which is going to just be astronomical, and it's very tragic. But that's where we are. He makes the point that with respect to a lot of high income earners, okay, big money, all right, some six-figure salaries, this, that, and the other, unemployment ain't going to do the trick. It ain't going to do the trick because we know that there's a significant portion, about 25% of people who make six figures, 100,000, 125,000, live paycheck to paycheck. Well, if they're collecting unemployment, they're collecting a fraction of what they actually make week to week. So what's going to take place? If they have to make ends meet, are they going to be able to do it with credit cards and hope for the best? Or are they going to tap into their 401ks or other retirement accounts to reach in and start selling some stock? So now you might get another wave of selling because people need the cash. And where do you think maybe, just maybe, they're going to sell? Maybe they're going to have to sell some of their winners. Who have been their winners? Apple, Microsoft, Amazon, Google, you know the names. Because what leads up typically leads down, and we have still not seen the worst of this, in my opinion. I think I'm correct when I say that, because we haven't seen those big boys really take a hit. And if you want to manipulate the stock market, those are the stocks that you have to buy behind the scenes because of how everything is weighted in these averages. If you just buy those stocks and you really concentrate on those ones, you can continue to have these major indexes show positive gains. But I think the music's going to stop for them too. I think once we start getting into earnings season and once the markets wake up to how bad this is really going to be, because it's not just a temporary shutdown. This is going to reveal all of those structural, fundamental issues that we talk about, which is why this podcast is in existence. They're going to come to the foreground. It's going to smack people hard right across the face. So many people out there just think that, oh, yep, it was real quick to the downside, therefore it's going to be real quick back to the upside. There's no ammunition. This is a false belief that central bankers and politicians can save the day again. It's not going to happen. They're out of ammunition. There's no capital base. There's no savings. And now you have a whole bunch of people out of work. I mean, this is completely flipped. Completely. I mean, you can look at the big sell-off at the beginning of 2018. You can look at the big major sell-off at the end of 2018. And you saw those type of V-shaped recoveries. You had an entirely different environment. Now you have an entirely different environment. People are now laid off in the millions. People are without health insurance during a global pandemic. What could possibly go wrong? The mortgage, the real estate is going to bust. Commercial real estate, residential real estate. We've been talking about this since the inception of the Capital News podcast, over a year now. That real estate is going to bust. That it's going to be a top-down, bottom-up squeeze this time. Last time in subprime, it was bottom-up. Subprime, and then all the dominoes started collapsing from there. Didn't really reach commercial real estate to any sizable degree. Now it's going to hit commercial real estate. It's going to hit the luxury condos, the penthouses, the skyscrapers, the McMansions, all of that jazz. And now with the layoffs, people who are financially on shaky ground to begin with, they're going to have to, they're going to end up in foreclosure. They're going to end up in default. So there's your top-down, bottom-up squeeze. And it's unfortunately going to be a bad reality. And this is not going to clean itself up anytime soon. And in fact, it's my belief, and I base this off of historical precedent, that the more the central bank and the federal government intervenes, the longer this process is going to take to unwind. And recall, during the 2008-2009 Great Financial Crisis, it was not allowed to completely unwind itself and delever, which is why we're going to have one hell of a problem this time, which is why I am terming this, in agreement with many others out there, that this is going to be the greatest depression. They might be well-intended, with good intentions, central bankers and politicians, although I'm skeptical of that. But even if they are, it's not going to solve it. And again, check out our letter, representation, and recourse, because we highlight all of those points, I think, in a rather succinct manner. I mean, we talked about a lot of things. Yes, it is a lengthy article. It's about 4.5 pages. But you know what? It's rather succinct when you take into consideration all of the things that we're facing. I think it's worth your time to either check out that podcast, Representation and Recourse, or check out our website, the Capital News, to read that article. And just to also let you guys know, I had some technical difficulty yesterday and continuing today, and I don't know if it's going to continue throughout the week. So those of you who actually listen off of my website, thecapitalnews.com, having some technical difficulties there, but I am able to upload these podcasts to our YouTube channel, also under the same name, The Capital News. So hopefully you can find it there. And of course, you can go to our website, thecapitalnews.com, click on the YouTube icon, and it should direct you there. And of course, it'll upload as well. You should be able to find it on Facebook and LinkedIn, but definitely YouTube would probably be the best bet until we get this technical difficulty worked out, whatever it might be. But I just wanted to let you know that I'm still working, I'm still putting out these podcasts, but for whatever reason there was a technical difficulty on the side of the back end of the website that's having some difficulty uploading. So still be on the lookout for the Capital News. We're still going. A little bit more with the market front, as we have the Asian markets open right now. We have the Japanese markets down about 1%. Across the board in Europe, they were also down, varying 1 to 4% depending on the index. Australian markets are trading right now. They are down 1.3%. Chinese markets are relatively flat, but up slightly. And the futures here in the U.S. are all pointing to the green, up about 1% at the time of this podcast. When it comes to commodities, there's still not a lot of upward movement yet. Although that might change short term. We talked about this on yesterday's podcast. We're going to talk about it a little bit more here today because there was some more news on this. But we have WTI trading at $21.40 a barrel. Brent is at $26.31 a barrel. Natural gas continues its downward descent. $1.59 per million British thermal units. Gold is down slightly, $1,585 an ounce. Silver is still right at that $14 an ounce level. Copper, which I know we haven't talked about Dr. Copper here in a while, but it is trading at $2.20 per pound. And lumber, which we haven't talked about in a while either, you recall during the melt-up phase that took place in the stock market, there was a big melt-up in the lumber market as well, going up to about $450 per thousand board feet. It is now trading at $260, so about $450, a little bit above it, down to $259, $260 right now. And aluminum. We've been discussing aluminum. It's been a while since we've talked about aluminum as well, I should say. It's below $1,600 a ton. So you look to the commodities market sort of as a gauge to see, well, what might actually be taking place, of course, globally, but specifically to China, because China has been the quote-unquote growth engine that's really been buying up all of these commodities. We've talked about the record amounts, the comparisons, put things into perspective. It's just wild how much they have purchased over the past 10, 12 years. So that's a good indicator. So yeah, they might come out with headline news or this statistic or that one, but there are things you can look at to get a more realistic picture of what's taking place beneath the surface. And the commodities markets, at least for now, is a good way to look at that because we have yet to see inflation start to take off in those commodities. But I do believe in time it will occur, not because of supply and demand, but because of inflation. Money printing, it's going to find its way, I imagine, to commodities sooner rather than later. To the bond front, we have the U.S. 10-year Treasury note down, yielding 0.59%. 0.59%. Of course, this is on the back of the Federal Reserve buying bonds and everything across the Treasury curve. And mortgage-backed securities, and commercial paper, and commercial mortgage-backed securities, and dollar swaps, corporate debt, on the primary market, on the secondary market, ETFs. They're just buying everything. What a great life it must be to be a central banker. Make forecasts, none of them are right. Say you're going to do one thing, then you do the complete opposite. Still have a job, still have benefits, make a good salary, or treated like royalty when you go in front of the media or any other type of think tank. Get the print money, and then you get to buy up assets. What a job. What a lifestyle. How can you do that? I mean, can you do that? Can we print money ourselves? Don't do it. Don't do it. Because they'll lock you up and throw away the key. But they get away with it. It's amazing. Truly amazing. So that's some of the markets. Of course, I give the futures here if I can. You never know if those markets are going to change by the time they ring the bell in the morning, but I do like to let the audience know what's taking place. With the energy space, energy execs go to Washington, or at least they'll be going to Washington, because in the midst of this oil price war, primarily between Saudi Arabia and Russia, there is, of course, collateral damage. And it might not be collateral damage, so to speak. It could be the intention, because it's a huge gorilla or elephant in the room, whatever analogy, cliche you want to use, and that being the U.S. shell. Because you're going to have companies, you're going to have states, particularly Texas, probably North Dakota, Pennsylvania, maybe to some degree New York and Ohio, and some others, they're going to take a huge hit. They're going to take a huge hit because they need oil prices higher than what they are. They need natural gas prices higher than what they are. And they're at decade lows right now. And the oil price war is not helping matters. So Donald Trump mentioned this the other day during a COVID-19 daily press conference and saying, well, in a way, it's a huge tax cut, maybe the biggest tax cut for the consumer. I don't buy into that rationale, by the way, but I understand what he's saying. But of course, in this dynamic, what good's it going to do? You're not going anywhere. You're not driving anywhere. You're not putting gas in your car because you can't go anywhere. Okay, you're not going back and forth to work. You're working from home. Most people. Mass transit shut down. School buses aren't on the road. So it's not really benefiting you, I guess, unless you have tanks and you're going out and buying it and storing it in anticipation that the price in the future will go up and you'll just, that's the trade-off you make. But he says, which is correct, the president, it might be good for some of the consumers, but it's not good for the U.S. energy industry, which is true, especially for those smaller, mid-sized corporations. It's not great news for the major players either. But as we stated yesterday, it's all about consolidation. We know this. We talk about it at length in our book, The Cynic's Guide to Investing. So we're going to see major amounts of consolidation throughout the entire economy. The government, the Federal Reserve, is picking winners. They're picking losers. So what do you think is going to happen? Consolidation. Bankruptcy alert, though we do have Whiting Petroleum. They have filed for bankruptcy. But of course, before they did, they awarded their executives almost $15 million in cash bonuses. Oh, isn't that lovely? File for bankruptcy, but before you do, I don't believe the timeline was immediately before, but it wasn't that long ago where the board approved executive compensation, a bonus, about $15 million in cash. What a system. What a system we have. And again, the bunch of fools that we have are rushing into the system to save all of them. It's just a travesty. I mean, it really is. Finally, you're starting to see some of the ratings agencies at least start to point that there's going to be some negative guidance, that they are saying that there is negative guidance on a lot of companies, on a lot of sectors, on a lot of industries. They have to. They have to save face to some degree. I would hope that some of these executives, the members of the boards, and the shareholders, I mean, come on. Let's say, come on, you guys got to save face. You got to have some credibility here. Anybody who can rub sticks together, anybody who can add up 2 plus 2 knows that there is so much junk in the system right now, that there's no way company after company, corporation after corporation is going to be able to make good on their debt payments. So come on, guys, get with the picture and at least issue negative guidance for sectors, for industries, for specific companies. Well, we're finally starting to see that, which we knew was going to take place. But, I mean, they should have seen this a mile away. We have here at the Capital News, we're nobody special. I don't have, private data. I'm going off of public sources here and common sense, which is not common, by the way. So another thing I want to talk about, because we've talked about it at length here, and it's going to be a continuing theme, and obviously we have, some bias towards the precious metals space. But I've been watching some interviews by Jim Rickards, and we've discussed Jim Rickards here before, Rickards. He's an author, analyst, economist, market analyst, whatever he wants to consider himself. You can typically find him more so online, YouTube. You're going to have to search him. I don't know how many actual TV interviews he gives, but you find him on a lot of alternative media. Again, and a best-selling author, so many books you can find him, or just listen to a lot of his interviews. They're typically about 30 minutes to an hour long, so you get some value out of it. And he is one of the few individuals that I listen to when he gives an interview. Don't always agree with him, but he gives some very good insight into pretty much everything he talks about. Very thoughtful individual, so it's worth checking him out. Again, Jim Rickards. But he is very bullish on gold. Has written a couple books on gold and thinks the price could go all the way up to $16,000 an ounce, and he explains how he comes to that number, basically all of the currency that's out there in circulation against how much gold is known to be out there, and then just doing the quick math that it comes out to about 16,000. Some people you'll come across, they think it's a multiple higher than that, and some people think it's not even going to come close. Everybody's got an opinion. Everybody does their analysis. I have no idea where it's going to go, but I do believe 1 ounce of gold is going to buy 1 share of the Dow Jones Industrial Average, and by the time I think all of this settles, it might cross, at $5,000 to $8,000 an ounce, okay, which would mean that's where the Dow is going to be, 5,000 or 8,000, and it's currently at 21,000 right now. So to me, it still has a long, long way to go. It's a process, despite the fact that it collapsed 30-35% over the course of a few weeks. It's nothing goes straight up, nothing goes straight down. So it's a process, and I imagine, I'm not going to be surprised if it gets there. I don't know if you will be, but I'm not going to be surprised. The rate at which we get there might surprise me, but getting to that number, no. And that's a sad state of affairs, but I think that could happen. But one of the things that I actually disagree with Mr. Rickards here is his call, because a lot of people are asking him, about the argument between deflation and inflation. And of course, he argues, like I do, that you can have both. You can have both. And there's no question that we are seeing deflation across many sectors, and that inflation can come out of nowhere, which is also what we have been stating. However, he likes to throw a little jab out there towards sort of the, I don't know what you want to call them, neo-monetarists, economists, and even Austrian economists out there. And if you had to put me in a bucket, if you said, Alex, okay, what economic philosophy do you associate yourself with? If I had to pick one, it would be Austrian economics. And so Mr. Rickards is out there saying, these guys, Austrians and the like, say, inflation is a monetary phenomenon, which of course I believe that's the case. But then he says, well, if you look at the CPI, there's no inflation out there in the marketplace. Well, I don't believe that to be the case. I believe there's a lot of inflation out there. I don't buy the BS number that is produced by the government. The government has a vested interest in keeping that number as low as possible. But I don't believe Mr. Rickards on this, because the money has gone somewhere. It's gone to financial assets. And he concedes this point that it has gone to financial assets. And of course, he's talking about the Greatest Depression as well, or at least a severe recession. No question about it. And he's been talking about the stock market being at elevated valuations and all those types of things that we talk about here. So to me, it's sort of a disconnect. How can you not sort of make that connection? That's inflation. Because you have to ask yourself, would the stock market have reached such valuations? Would it have been so disconnected from the underlying economy had it not been for that money printing? And the answer is no. So that to me is inflation. It's just a question of policy as to where that money is going to funnel, where it's going to find itself. The hope amongst market bulls, who are also market fools, think, well, the Federal Reserve's doing the same thing they did a decade ago. Congress is doing even more now. It's going to go back into financial assets. It might, but I'm highly skeptical of that this time. I think it's going to go into commodities. I think it's going to go into food. And you're really going to see CPI spike. Okay? Consumer prices. No question. Everybody thinks the last thing is going to happen again. We're all guilty of that recency bias. That happens. No question about it. But I just don't think that you can make that distinction between financial assets and consumer goods and services and everything else. It's all in the economy. And our economy is so financialized, if you will. I just don't think you can separate the two. Because you have to understand, a decade ago in the subprime crisis, a lot of money that was printed went to that sector. It went to those individuals with those subprime loans. Well, what happened? They failed, which was virtually mathematically inevitable. And then what happened? Well, those banks got bailed out. The people lost their homes, lost their jobs. But Congress had to look like the sheriff riding into town, so they had to do something. So they had to put on regulations. They had to come up with something. Think of the Dodd-Frank bill and all of those regulations on the financial and banking sector. And they said, oh, no, well, you can't do this again. Not that I think many banks were in a rush to lend money to people who couldn't pay it back. But nevertheless, they're now saying, okay, you got better capital buffers. You got restrictions. These people have to have better credit scores, blah, 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 blah. Can't go that route, right? So the regulations, in a way, said, okay, well, now, all right, we got this money because we were bailed out. We still want to invest in real estate. Well, who are we going to give the money to? Ah, and there you have it. You have the commercial real estate bubble. You have the luxury end real estate bubble, residential real estate bubble that we are in the midst of popping. And that's your top-down, bottom-up squeeze that's going to take place again. But the point of this is to say central bank money printing and government policy is going to sort of tell you where that money is going to go. You understand what I'm saying here? Because if you want to make the argument that inflation only occurs due to what's termed as the velocity of money, which means how many times $1 changes hands, I create $1 through production, I go spend it, I give it to a store, that store spends it, that store spends it, that store spends it, okay, keep going on and on. The more that happens, the higher inflation should be. That is correct on the consumer price side of things. But financial assets are very much a part of the economy. So I am saying everything is in my bucket. I'm not separating them. And depending on what you're talking about, even from consumer prices for goods and services, you know as well as anybody out there, because you're paying bills, that there is inflation. And the reason the government has a vested interest in making sure that the inflation rate is as low as possible, as much as it's in their control, is because of Social Security. Because Social Security is supposed to have cost of living adjustments built into it. COLA, C-O-L-A, cost of living adjustments. Well, it doesn't take a genius. If you have lower inflation, you have a lower cost of living adjustment, which means you get a little pay raise. Well, inflation's only 1%, it's only 2%, so guess what? That's all you're going to get. Even though in reality, it's really 5, 6, 7, maybe 10%. But they're not going to let you know that. You know that. That's why people can't make ends meet. Because there's the theory, there's the BS number that the government throws out there, and then there's the reality of what it really costs to live. People understand this across the country. So the government has screwed people at least 3 ways. especially people who are retired or near retirement, because you've had to pay taxes your entire adult life. You've been screwed by central banks who have inflated your purchasing power away. And now, as you are about to or are collecting Social Security, the government's screwing you again by manipulating the cost of living adjustment through inflation. Does anybody understand this? Does anybody even care? This is why it's a bunch of April Fools. And May Fools in June and July and August and September, blah, 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 blah. This is simple stuff. Nobody asks questions. They just say, yeah, dear leader, do what you want. I like this guy. I'm tired of him. Now I'll vote for the other guy. And then the same shenanigans takes place. It's a vicious, vicious cycle. I'm tired of paying for it, which I outlined in the letter. I'm not paying for this junk. This is garbage. I didn't vote for it. I don't want it. This is not benefiting me. In fact, it's screwing me and my generations and many generations to come. It's not moral. It's not ethical. It's un-American. I love this country. I'm a patriot. I don't stand up for this nonsense. I didn't vote for it. I don't want it. I don't want to pay for it. Which is why I asked the question, where and what is my representation and what is my recourse? And I am waiting on pins and needles for these fools, my congressmen and senators, to answer that question. That's all I'm waiting for. So, a lot to digest. Oil executives, again, are going to Washington, D.C. to meet with the president to see what can they do to get the price of oil up. The president is supposed to be in not constant contact, but at least in open contact, in communication with Vladimir Putin, and I imagine the Crown Prince of Saudi Arabia as well, to sort of say what's going on here. You got to get these prices back up. Again, they could come out, and to me anyway, it'll be short-lived. If they come out and they make an agreement that they're going to cut output. Okay, you're going to cut output. All right. Oil might take off for a little bit. Again, like it did when Iran attacked the Saudi Arabian oil facility, when they attacked Iraq, when we retaliated, when they hit the ships. It spiked, and then what happened? It came right back down. And this was all before COVID-19. Because the global economy was slowing down. And you cannot fight the force of economic gravity forever. Yeah, you get that spike, you get that headline news, you get that geopolitical risk, and then the markets say, well, look how much supply still remains on the market, and look how little demand there is. And the prices came back down. And it happened again, another spike, and then up. The fundamentals of supply and demand came back. And that's what's taking place across every single sector. COVID-19 was the pin that pricked the everything bubble. A bunch of April Fools, ladies and gentlemen. I hope you're not one of them, but I think to some degree we all are, because we've been played like fools and we're considered fools. I got to harp on it because I really believe that this $1,200 is just bribe money to sit down and shut up. But I really ask you again, this audience, through a peaceful revolution, to leave the Republican and Democrat Party. Again, become a libertarian, a constitutionalist, an independent, unaffiliated. Leave the parties. Make this a wake-up call to these people, because I don't know what else is going to do it. Civil disobedience, people striking, marches across the country. Of course, you can't go out and march. You can't be shoulder to shoulder. You can't be linked arm in arm. Social distancing. So, how convenient to everything. But pay attention, ladies and gentlemen. We're just getting started, and it's just the start of the second quarter. Buckle up. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Koritis. Godspeed.